Good morning, everyone, and thank you for attending today's conference call. Before we commence today's presentation, we want to acknowledge the traditional custodians of country throughout Australia. We celebrate their diverse culture and connections to land, sea, and community. And we pay our respects to elders past, present, and emerging, and extend that respect to all Aboriginal and Torres Strait Islander peoples. As many of you know that have followed HealthCo's journey since IPO, FY24 was a transformative year for the group. Clearly, we are immensely proud of the operational results that HealthCo has delivered, while acknowledging the unit price performance has been underwhelming. The operating and earnings performance through FY24 and continuing growth outlook reflect the critical infrastructure-like characteristics of HealthCo assets. Ultimately, this asset class is supported by megatrends of a growing population, an ageing population, and requirement for more investment to meet the needs of the broader community. Irrespective of the short-term debate about operator costs and revenue from private health insurance funding, the private hospital sector remains undeniably integral to the provision of healthcare services for the Australian population. It provides a critical support function to the public system, which itself is consistently operating at above capacity with long waiting lists for care. Our portfolio of high-quality private hospitals and critical healthcare infrastructure represents irreplaceable real estate, which continues to outperform traditional real estate subsectors. This outperformance underscores our conviction in the asset class and reinforces our decision to continue deploying capital into HealthCo's value-accretive development pipeline. FY25 will be another busy year in terms of portfolio enhancement and development pipeline activity, which we will touch on later. With those overview comments, outlook, I'll now pass over to Christian, who will provide further detail on the operating highlights for FY24 and an update on HealthCo's strong financial results for the period.
Thank you, Sid, and good morning, everyone. Let's turn to page 4 for the highlights for the year. Financially, we delivered 16% earnings growth. FFO of 8 cents per unit and DPU of 8 cents were consistent with guidance. Our balance sheet remains strong with gearing of 32.5%. Operationally, we continue to collect 100% of our rent. In terms of growth, we established the unlisted healthcare fund together with 4 global institutional investors. We have completed around $200 million of asset sales at attractive pricing, with proceeds reinvested into our accretive development pipeline and the $50 million unit buyback program. Let's turn to page 6 for an update on HealthCo, Australia's second largest private hospital operator. While there's been a lot of debate and news flow about the broader private healthcare sector, I want to highlight that our private hospital portfolio represents critical healthcare infrastructure and that we are well placed as a landlord. Our hospitals provide high acuity services, including intensive care units and emergency departments. They are located in metro locations in the 4 largest state capitals in the country and manage 373,000 patient episodes in calendar year 23. They are critical to the delivery of healthcare services in Australia and cannot be replaced. Importantly, from a landlord perspective, HealthCo is paying all rent in full and on time, while HealthCo remains in a strong legal position. Let's now turn to page 8 for more detail on our asset portfolio. HealthCo's high-quality $1.6 billion portfolio underpins our strong earnings growth. The portfolio provides high income security with 100% rent collection and long lease expiry of over 12 years. Our portfolio also provides inflation protection, with 81% of our leases being CPI linked. So the investment fundamentals are attractive. and our portfolio is infrastructure-like in character. Let's turn to page 9 to explain what I mean by that. Our assets provide critical and high acuity healthcare services. One example is Knox in Melbourne, one of the largest tertiary hospitals in Victoria with over 330 beds. It offers a full range of complex surgical services, including a 24-hour emergency department. Importantly, patient volumes have continued to grow following the completion of a significant brownfield expansion project. On page 10, we highlight the attractive metro locations of our assets. 93% of our portfolio is located in metro areas in the 4 largest state capitals: Sydney, Melbourne, Brisbane, and Perth. Our assets are located in fast-growing areas, like the George in Camden, which is the fastest-growing LGA in Australia. Let's move to page 11 for an update on the unlisted healthcare fund, which we established in the first half of FY24. The unlisted fund's investment strategy is complementary to that of HCW and provides HCW with exposure to higher total return opportunities. And the fact that we're partnered with 4 global institutional investors highlights the broader attraction of healthcare real estate as an asset class. In FY24, the funds completed brownfield developments at Knox and Nepean at funding rates of up to 7.5% cash yield on cost. The unlisted fund is seeking to grow further in FY25 and beyond, and is well placed to act as a funding partner for HealthCo's broader development pipeline. Moving on to page 12 for an update on HealthCo's asset recycling program. We have sold $195 million of assets since the HealthCo transaction last year. We have continued to redeploy proceeds into our accretive development pipeline while maintaining a strong balance sheet. Turning now to HealthCo's sustainability program on page 13. We have continued to build on the foundation work of HMC Capital's wider sustainability framework in support of our objective to create healthy communities. Throughout FY24, in line with our net zero energy roadmap, we achieved a 30% reduction in Scope 1 and 2 carbon emissions. This is largely associated with our smart energy management system rollout and our ongoing investment in solar infrastructure. Beyond those asset-based initiatives, HealthCo is also uniquely placed to deliver social impacts in the community through our investment in healthcare infrastructure, as well as facilitating access to essential health services in the community. We are proud of the achievements we have made to date and are well placed to continue progress of our sustainability strategy at HealthCo. Moving on to developments, starting on page 15. Developments form an important part of HealthCo's growth strategy. We have a strong track record with $300 million of projects completed since the IPO. These projects have delivered great facilities for our tenant partners and accretive returns for our unit holders, with cash yield on cost of up to 7.5%. Now turning to page 16, where I'll provide an overview of the development pipeline. We have an exciting development pipeline of over $500 million. This pipeline is comprised of HealthCo portfolio projects in the near term and Camden and Rouse Hill in the medium term. These projects will deliver attractive returns with a target yield on cost of 6 to 7%. Importantly, we will engage with the unlisted healthcare fund to act as a funding partner to unlock these opportunities. So, as you can see, our portfolio is performing well. Importantly, HealthCo is well placed to continue both its strong operating performance and strong earnings growth trajectory. Moving now to the financial results, starting with the earnings summary on page 18. HealthCo delivered a strong financial result for FY24 with 16% earnings growth and a 100% FFO covered distribution. FFO of 8 cents per unit and DPU of 8 cents were both consistent with guidance and represent a strong overall financial result for our unit holders. HealthCo's balance sheet remains strong, as you can see on page 19. NTA of $1.64 per unit was consistent with our half-year results, while HealthCo's valuation movement to June was flat on a net basis. Both these metrics reflect the infrastructure-like characteristics of our portfolio. Now turning to capital management on page 20. Gearing of 32.5% is at the lower end of our target gearing range, while we were 78% hedged as at June. We will remain disciplined in terms of how we deploy capital. Now turning to our guidance for FY25 on page 22. We are targeting 5% earnings growth in FY25. This means that we're expecting FFO of 8.4 per unit and DPU of 8.4. And I'll now hand you back to Sid for concluding remarks.
Thank you, Christian. We believe today's presentation once again demonstrates that HealthCo is well positioned to continue to deliver attractive risk-adjusted returns for investors. Our priority in FY25 is to deliver on the strong FFO per unit guidance that Christian has spoken to. Strategically, we are focused on addressing the unit price discount to NTA, and we will continue with proactive capital management initiatives if the discount persists. I will now hand over to the operator for questions.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're using a speakerphone, please pick up the handset to ask your question. Your first question comes from Lauren Berry from Morgan Stanley. Please go ahead.
Hi, good morning, guys. Just wondering on the capital recycling, you flagged in your outlook that you're looking to continue the program. Is there any sense of how many assets or what quantum of assets you might be looking to divest?
Hi, Lauren. Thanks for the question. So we've gotten through the bulk of the $200 million target that we set ourselves last year. We're not going to place any target that's forward-looking around asset recycling, but suffice to say that if you have a look at slide 12 of our asset recycling program, we'll be focused on being commercially rational and look to asset recycle as and when appropriate to redeploy into our development pipeline.
Any particular asset classes that you might be looking to downweight?
We have always said that we're comfortable with our diverse portfolio composition, and at any given moment in an economic cycle, we may upweight or downweight particular subsectors. So, no, I wouldn't want to give you any colour as to which subsectors.
Okay, sure. 6 months ago, you were talking about your development pipeline was around the $800 million mark. At the moment, you've flagged 540. Could you talk about the difference in size there, please?
Yeah, so Lauren, the main driver of that is some of the development pipeline that's already been spent. But I also ask you to have a look closely as to the explanation provided. The previous pipeline was an as-complete value, whereas this is a capital to be deployed value.
Right. So is the implication there that there is potentially $260 million of profits that could come out of that pipeline?
That's an implication you could draw, yeah, but I'm happy to share with you the bridge of the development pipeline that's already been executed upon, and then we could provide you with some colour on our one-on-one as to what that delta is.
Okay, sure. Thank you. And look, final one from me, just your operating cash flow, even if you include the distribution from the unlisted fund, is quite a bit lower than your FFO that you've reported today. Are you able to talk about the reconciliation?
As you may recall, Lauren, when we did the HealthCo transaction, as part of constructing that deal, we provided HealthCo with 2 years of half rent. That's the primary delta between the FFO and the cash that you would be seeing.
There's about a $30 million difference just at the balance sheet line. Does that really account for the incentive?
So just on that, Lauren, as well, there's also a deferred distribution from the unlisted fund that we have subsequently received, so that's around 4 million. And then there are additional incentives across the portfolio as well. But I think the important point to note, further to Sid's comment, is that we expect cash flow conversion to continue to improve as we go forward with the HealthCo incentives for the HCW balance sheet hospitals running off in FY25, and we also got the rent incentive at Camden as well running off in FY25. So overall, we'll see cash flow conversion continuing to improve for HCW.
Okay, thank you.
Thank you. Once again, if you wish to ask a question, please press star one on your telephone. Your next question comes from David Pobucky from Macquarie Group. Please go ahead.
Morning, Sid, Christian, Andrew. Congratulations on the result. Just the first one, in terms of the buyback, you mentioned that you might consider directing a greater share of asset sale proceeds to increasing the on-market buyback. Do you mean increasing beyond the $50 million or just accelerating it?
Hi, David, it's Christian. So as we've said and Sid said, we're looking at ways in which we can deploy capital in a creative manner. And as we stand today, we were looking to recommence the buyback at current levels as the unit price is today.
Okay, thank you, Christian. In terms of the hedge book, it rolls off materially from June 25 to June 26. Just any kind of thinking around managing that between now and then, please?
Yeah, you're right. You're right about that, David. I mean, in terms of our hedging policy, we're looking to have our debt over 50% hedged. The swaps we have in place are rolling off over the next 3 years. I think if you take a forward-looking view on interest rates, that could well provide a tailwind for earnings going forward. And as a note, if our cost of debt goes down by 25 bips, that will improve earnings by around 0.2 cents per unit.
Thank you, that's clear. And just one final one from me. The EBITDA cash rent coverage for HealthCo of over 3 times. Does that include the initial concession that you gave them, or does it exclude it? That's
on the cash basis, David. That's on the cash basis. But I think it's important.
Sorry, go ahead.
No, that's fine.
Right. Thanks for that. I appreciate it. Good luck for the rest of the year.
Thanks, David.
Thank you. Once again, if you wish to ask a question, please press star one and wait for your name to be announced. Your next question comes from Andy McFarlane from Bell Potter. Please go ahead.
Good morning, guys. Look, just a couple from me. Just wondering if you can just give us a little bit more colour on the bridge and kind of what's driving the 5% EPS growth for FY25.
Yeah, so hi Andy, it's Christian. So it's continued contracted rental escalations across the portfolio and also full impact from developments that completed in FY24.
Understood. I guess just one follow-up for me, just around, HealthCo. Obviously, appreciate a bit of detail in the pack today, but just wondering, what the latest is from recent conversations with them and, what the status is of the debt renegotiations to the extent you can comment.
Andy, wouldn't want to comment on HealthCo's negotiations with their lenders, but suffice to say that we've had constructive dialogue with them. We support them in terms of their discussions with private health insurers, and they've been honouring all of the terms of their lease agreements with us, and there has been no change to the contractual agreements we set in place when we undertook the transaction.
Thanks, Sid.
Thank you. There are no further questions at this time. I'll now hand back to Mr. Sharma for closing remarks.
Thank you all, and thank you all for the interest and time dialing in today. In closing, we'd like to thank our shareholders as well as the entire HMC Capital team, our HealthCo board and our tenant partners for their contribution to this result. We remain steadfast and focused on not only executing upon our operating guidance that we've provided, but also closing the NTA gap as much as we can through our control. Look forward to catching up with you over the next few days. Thank you.